When you have a liquidity crisis, everything goes to a correlation of one. And so you sell what you can to get dollars in liquidity. So that's the reason. So a lot of, I don't know about a lot of, but some certain central banks were dumping gold because they needed liquidity. But that doesn't change the long-term trajectory of gold going much higher, because the purchasing power of the U.S. dollar is going down against hard assets. I mean, you look at our debt situation, our deficit situation, our intractable problem with inflation. Those things are only going to go, get much worse. So own your gold, own some silver.
In times of financial stress, markets behave very differently from what is expected. Liquidity becomes the priority, and even safe haven assets like gold can be sold to raise cash. MichaelPento, a well-known macro strategist and market commentator, explains that during liquidity crises, correlations across asset classes tend to converge, meaning everything gets sold as investors rush for dollars. He notes that even central banks have occasionally sold gold in such moments, not due to a lack of confidence in the metal, but because of urgent liquidity needs. However, this short-term pressure does not alter the long-term outlook. With rising sovereign debt, persistent deficits, and structural inflationary challenges, the purchasing power of the dollar continues to erode relative to hard assets. This environment supports a strong bullish trajectory for gold and silver over the long term. Periodic selloffs may create volatility, but they often present accumulation opportunities as the broader macro trend remains intact. Now, we present the clips from MichaelPento's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
When you have a liquidity crisis, everything goes to a correlation of one. And so you sell what you can to get dollars in liquidity. So that's the reason. So a lot of, I don't know about a lot of, but some certain central banks were dumping gold because they needed liquidity. But that doesn't change the long-term trajectory of gold going much higher, because the purchasing power of the U.S. dollar is going down against hard assets. I mean, you look at our debt situation, our deficit situation, our intractable problem with inflation. Those things are only going to go, get much worse. So own your gold, own some silver. I mean, the reason why you want to overweight gold in your portfolio is when you start to see economic data fall, when you start to see us wax towards a recession. And that is not happening at this moment. I think the summer is something I have my eye on because of that, the expiration of the OBBB, One Big Beautiful Bill benefits. But right now, gold is about 5%, gold and silver about 5% in my portfolio. That number will go up if my hypothesis is correct about the summer weakness coming in the U.S. economy. I think gold is, that's why gold isn't really an investment. It's a perfect placeholder of your wealth. So it increases in price in dollar terms, but its purchasing power never changes. That's the beauty of having gold. It's real money. Mm-hmm. And that's a perfect illustration of it. So if you had your money, if you had your wealth in dollars, you can't afford a house. If you had your wealth in gold, home prices aren't so bad. The liquidity is draining. The consumer is under stress, and these things are taking more time than what most people think, because when you print $4.5 trillion and shove it into the banking system, it takes a long time to drain that liquidity out. I'm talking about the reverse repo facility, the excess reserves of banks. But that money is now zero now. There's nothing left really. It's essentially zero, and consumer savings rates are being drained rapidly. So we have not abrogated the business cycle. We have not annulled recessions. They happen. Are we in one now? No. Am I bearish and negative the stock market now? No, I haven't been negative the stock market since the spring of 2023. I'm just pointing out that there's massive imbalances in home prices and equities and in credit. We have more debt today, much more debt nominally, but at least in terms of GDP, our debt levels are the same as they were heading into the global financial crisis. So I'm just saying that these bubbles have to reconcile themselves, and it will happen. Getting the timing right is what I am focused on myopically. So there's substitution in there, there's hedonics in there. So the point of the matter is it's still up 0.9% month over month and 3.3% year over year, and that's the way they calculate it. That's post the Boskin Commission methodology. So you could just double that number if you want to be honest.
Right.
Yeah, but like I said, it's being offset by the government stimulus from the tax cuts, but that goes away in the summer. So that's when I expect things to really bite. If oil is still at $90 to $100 a barrel, if it goes back for some miracle, then but I just can't see that happening. I just don't see it happening. I think oil is going to stay near that level or higher for at least until the summer. It's the bottom end of the consumer spectrum who spends 30-40% of their income on energy and utilities and food. And that their discretionary income has been eviscerated, as I point out. So that's the sad part. And what's the reaction function from our central bank? It's to expand the base money supply by $130 billion, and they were, at least thank God they're not doing it now, but they were cutting interest rates into this. And there's still some members who want to continue cutting interest rates. You wouldn't raise interest rates, even though I would, but they will not raise interest rates because of an oil price shock. It's pretty much a one-time jump in the CPI. But what they should have been doing was raising rates a long time ago. I don't know why, Danny. The Federal Reserve was buying mortgage-backed securities in the spring of 2022. What were they doing? Why did Mr. Powell print $4.5 trillion following the COVID outbreak? $4.5 trillion of base money supply. It's totally unnecessary. And the COVID scare was over well before 2022 came, but he was still expanding the balance sheet. And that's why home prices are unaffordable. And that's why the real estate transaction market is pretty much frozen, because you've priced out everybody from the market, and home price appreciation now has stopped going up. So
are there any parallels?
Part of that reverse wealth effect. This is a very stagflationary. This is a stagflationary environment that has some aspects of what I call sector one in my portfolio, which is some aspects of risk off. So it's stagflation is one of the most difficult environments to invest in, but you have to have energy and you have to have precious metals if you have any chance of providing alpha for you and your clients. Well, the labor market is very weak, despite that report that came out, the March non-farm payroll report. I think it was 178,000 net new jobs created. But the big number you have to remember there is that the aggregate hours work number was down. In other words, most of those jobs were part-time in nature, low wage, no benefits, and low hours. So it doesn't make a difference if you hired two people, and instead of hiring one person, you hired two, but the two people working 7 hours, and the hiring one person was not working 8. So they fired the one person who's working 8 hours a day, and you hired two that are working 6 or 7. The labor impulse into the economy is falling. That's the most important thing. And of course, real wages are falling too. We had the PCE report showed that we have nominal wages are falling. Nominal wages are falling in the context of inflation going higher, which means real wages are plummeting.
When liquidity tightens, markets enter survival mode, forcing indiscriminate asset sales for cash. Gold may face short-term pressure but remains a long-term store of value amid debt, deficits, and inflation. As liquidity drains from the system, consumer savings are rapidly eroding while real wages continue to fall against rising living costs. The effects of past monetary expansion, including trillions injected into the system, are now reversing, exposing structural imbalances across housing, equities, and credit markets. With energy prices remaining elevated and lower-income consumers under increasing pressure, economic momentum is weakening beneath the surface. This environment reflects the characteristics of stagflation, in which growth slows while inflation persists. In such conditions, hard assets tend to regain strength over time as fiat currency purchasing power declines. Short-term volatility may persist, but the broader trajectory points to rising demand for tangible stores of wealth as economic pressures intensify in the coming cycle. Let's get back to the interview.
I wasn't shocked by it, but what shocks me is that the Federal Reserve is still thinking about cutting interest rates. And I think that's the shocking thing about the CPI number that came out today. It was up 3.3% year over year, up 0.9% month over month, which is a pretty shocking number. And the conversation isn't about hiking rates. I mean, the Fed has missed the inflation target for 5 stinking years. It's now 3.3% on the core PCE, which is their favorite metric, and the last time I checked, but the new math is not really something I'm a master of, but I think 3.3 is higher than 2, right? So if 3.3 is higher than 2, and we've been above 2 for 5 years, why are we talking about rate cuts? Shouldn't we be talking about rate hikes? But anyway, we are talking about rate cuts. The Federal Reserve printed $135 billion since December of 2025. Yes, they printed $135 billion with a B dollars since the end of last year. And that's not just regular money, it's high-powered money. So it's Fed credit. That's the increase in the Federal Reserve's balance sheet. So that's bank reserves that are the base money, part of the base money supply. It's the liquidity for banks. Does anybody care about that? They should, because inflation has eviscerated the bottom 4 quintiles of the American consumer. And the bottom 4 quintiles are severely damaged. The top quintile, the top 20% are keeping the economy going. So I'm not talking about a disaster here. I'm just trying to talk about truth and facts. Higher oil prices, higher inflation. You have a stock market that's, just a few percentage points off its all-time high. I think it's like 3% off its all-time high, and still down on the year, but barely down on the year. 220% total market cap of equities to GDP, extremely expensive stock market. And there's not much bad news priced into this market whatsoever. So we could talk about how I'm invested. I'll let you back in and answer some questions. But we have a very, very tenuous situation, a tenuous piece, and a very, very tenuous stock market. It's predicated on 3 bubbles. The economy is predicated and built on 3 bubbles: real estate, equities, and credit. Yeah, I mean, if you're right now, I'll get to it. I'll get to the punchline here. I'm 70% short-term treasuries right now in the market. I have some gold, I have some silver, I have some aerospace and defense stocks. I have a little bit of foreign equities that I own. I have one small short, but I'm very neutral in the market here. The market could go up and I won't make much money. I'll make a little bit. The market can crash and I won't lose much money. I might even make some. I have some energy in there, commodities, but I'm very much protected for me and my clients. This is still a very fragile situation. Now, I believe President Trump wanted to impose maximum tariff level. Remember Liberation Day tariff levels on April 2nd? That was Liberation Day. President Trump he thought long and hard about what the tariff level. So when the market went, quote unquote, yippee, as he described it, that was his cue to say, listen, the bond market is cratering, prices down, yields higher, repo market's fracturing, stocks are in free fall. I cannot do this maximum desired. I can't have my druthers when it comes to tariff levels. So Liberation Day tariffs were abrogated, annulled, canceled, and they never came back again until their full capacity. And we have today is like a 10 or 20% tariff level, not the 30 and 40, 50% that was there. That's what he wanted to do. To his credit, he wanted to rebuild American manufacturing and manufacturing renaissance, balance our trade deficit, instead of just giving other countries paper dollars and selling away our future with interest. He wanted to do something. But that didn't work because the market wouldn't let him. Well, it's the same functionality here. The market is not letting him. I totally disagree with the war. I disagree with taking out. I agreed with taking out the Ayatollah Khomeini, who killed supposedly tens of thousands of his people when they protested. That he had to go. And making sure they don't have a nuclear weapon. But we did that as I said, in the summer of 25. So I didn't understand why this war lasted weeks and weeks, actually over almost 2 months, right? Started in February. So it was well over a month that the war lasted. And I don't understand the purpose. What we have now is we've inculcated to anybody, any rogue nation that doesn't have a nuclear bomb, they need to get a nuclear bomb as fast as possible, because it's the only thing that's going to stop them from being attacked by the United States. North Korea has one. That's good. Cuba doesn't have one. They're in trouble. Venezuela didn't have one. They're in trouble. Iran didn't have one. That's where. But if you're Pakistan, you're good. You don't have to worry about it. So that's what I'm most concerned about long term. We haven't really accomplished much. But this piece, what the point I'm trying to make is, Trump is looking for an off ramp. The market thinks he found one. But there's 2 other actors here, at least 2 other actors. There's Israel, does not want to relent until there is genuine not personnel change, regime change. In other words, the IRGC has to be wiped out, and the theocracy has to be wiped out. So they're not relenting. And also, Iran says, well, listen, we can have not plenary the world economy, but significant footprint in the world economy by controlling the strait. That's their way of making money now. I mean, we weren't buying Iranian oil before, but now Iran could say we're charging a toll for every ship that travels through the Strait of Hormuz. So they can enrich their nation now more than ever before. So I think it's premature to say that we are Trump looking for an exit ramp. So that's what's going to happen. But the fact of the matter is that if he wants an exit ramp, oil's going to stay at $100 a barrel. And if he wants to make sure it goes back to $60 a barrel, he's going to have to take over the Strait of Hormuz, which is boots on the ground and a long protracted war.
The system now faces persistent inflation and fragile markets. Despite years of above-target inflation, policy remains inconsistent, with ongoing liquidity injections and persistent price pressures. This causes asset prices to remain high while economic strength weakens. The reality is that multiple bubbles, real estate, equities, and credit, are now supporting the system simultaneously. With inflation still above the Federal Reserve's stated target and liquidity expanding quietly, the pressure on consumers, particularly in lower income brackets, continues to intensify. At the same time, elevated energy prices and geopolitical tensions, especially around critical supply routes like the Strait of Hormuz, are adding another layer of risk that could sustain inflation longer than expected. In this climate, capital preservation outweighs risk-taking, as volatility can spike from these pressure points. While markets may hold short-term, fragility builds, risking sharp adjustments if confidence slips. Share your thoughts on his analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.